doing a video on investing, and please read my disclaimer below. I'm not a professional financial advisor at all, just an amateur, and so please check out that disclaimer. So I wanted to show the calculations for a 10-year Treasury note. So these are so-called plain vanilla Treasury. You buy it from, say, treasurydirect.gov. Say you give them $100, and actually it would be more or less than 100. You would buy it for, say, I'm just throwing out some examples here. Maybe $98.50 if the note was selling at a discount, or maybe you'd buy it for $101 if the note was selling at a premium. So it all depends on the market conditions. But just for purposes of this example, let's just say you actually get it for $100. You buy it for $100. So they all come with a rate. I have 2.29. That's the current 10-year Treasury note rate, and this determines how much interest payments you'll be getting. And I'm actually just going to, well, let me leave it like that for now. So how these work is that, so you would give them $100, and then these notes pay you every 6 months. So if in a year you get 2.29% of $100, or $2.29, in 6 months you get half of that, or roughly $1.15. Okay, so every 6 months you get $1.15, and roughly, so that comes out to about $2.29 a year. So for the first year, that's this row, that's what you get, $2.29. And second year, same thing. You get every 6 months $1.15, $2.29 a year, and then adding that to this total, just keeping a running total here. Second year, you'd have $4.58. So you go on and on like that for all the years. Now on the 10th year, remember this is a 10-year Treasury note. So on the 10th year, what happens is you get your $2.29, but it's kind of the end of your investment, so to speak. You also get your original principal back. The $100 you invested, you get that back. So really in the last year, you're getting $102.29. So if you keep the running total, your grand total from this is $122.90. So in year one, or a little before year one, you gave them $100. At the 10th year, you have made a total of $122.90. So that's how Treasury notes, and also that's how Treasury bonds work. Bonds, the years would just be a longer time, say like 30 years, and the rates would be larger, say 3% or 3.5% or something of that nature. But that's how they work. So I just thought I'd share this. If none of these investment topics are mysterious. It's just that people maybe don't know about them or whatever. So well, let me just use the extra time to talk about Treasury notes, Treasuries in general. So one complaint is that this rate is very low, this 2.29%. I mean, a common complaint is, who wants to lock up my money, $100? Who wants to lock that up for 10 years, only to receive $22.90, which then in that time would get eaten by inflation? Those type of arguments. Well, the counter argument to that is that I know exactly what I'm getting, and it's as close to a guaranteed investment as they come. There's also other treasuries that have inflation. They have explicit inflation protection adjustments that they do. So while not perfect, at least they're trying to make an explicit adjustment. These notes aren't, but some other ones are, like TIPS. There's floating rate notes, and there's also I savings bonds. So TIPS, floating rate notes, and I savings bonds, they have rates that get adjusted. They get updated. So at least they're trying to make some explicit adjustment for inflation or changing conditions. So with stocks, for example, you can find things with you can find stocks that have dividend yields way higher than 2.29%. The issue is that it's not guaranteed. Now, even for large companies, successful, the bluest of the blue chip companies, that's not guaranteed. So they could decrease the dividends, they could cut the dividend entirely, eliminate it. They could go out of business. They could just have a really bad economic downturn, and when you need to sell the stock, the price may be a lot lower than when you originally purchased it. And so in this case, these 229 every year is virtually guaranteed, and I'm getting back what I invested to begin with. Moreover, you can use it for planning. So again, since there's a mathematical formula that tells me every year what I'm going to receive, you can plan out your purchases. So say, for example, in 10 years, you have a child that will be college age. So say you have about $10,000 to spare, and maybe the rate here now it's gone up a little bit, 2.4%. I don't know, something like that. Let's decrease it to $5,000. And you can kind of work backwards too. Like, I mean, let me just say it like this. So say for college you need $5,000. At 10 years time, you need $5,000. Say that's going to cover this child's books and things like that. So you want this grand total to be $5,000. And you know the rate is 2.4%. So how much would you need to put here in the amount in order to get this to be $5,000? So let's just try some numbers. Let me put 4,000. Okay, that's pretty close actually. Let me put 4,500. 4,100. Well, let's just say 4,000. So see, you can kind of plan it out like that. That if I put in $4,000 right now in the 10-year Treasury note, and if the rate is 2.4%, every year I'll get roughly $100 in interest payments. And then at the 10th year, I'll get that plus the original principal of 4,000 back. And then I'll have roughly 5,000, to give my child for their books for college. And that's just kind of a simplistic example. In reality, what you could do is, instead of just letting all of these payments accrue in your account as cash, you could invest these payments, right? So, and that's where the growth comes in, that lots of people, they just see the rate and an amount and only a little bit of money after 10 years, and they think that's it. But really what you're doing is, along the way, you could take these payments that you get every year and invest those in something. Maybe invest those in something, maybe in more notes, or maybe in savings bonds or stocks or anything. You could invest them in, you could invest these interest payments in investments that have rates greater than 2.4%. This is just to kind of quote, again, it's quote guaranteed because nothing's guaranteed, but treasuries are the most guaranteed investment there is. So what you're doing is you're securing basically 10 years worth of income and the principal. You're securing it for the future. Okay, so I hope this video helped maybe demystify a little bit of what Treasury notes are, or Treasuries in general, or their benefits or cons. Um, really good for planning, really good for securing future income. And rates are low, but comparing them to other rates is really apples and oranges, because this rate here has lots of quality built into it. These payments are essentially as guaranteed as it gets. So, and you get your principal back. So while the overall payout might be pretty low for tying up your money for 10 years, you can also invest these interest payments along the way in whatever you want. And that's where the growth factor really comes in. And I'll do more videos on that in the future. But anyways, I hope this helped. I hope you found it interesting. And I'll see you next video. Thanks for watching. Bye-bye.